Hi, this is Dan Joseph of the China Learning Curve. Is it time to abandon China? This is the second of our four-part blog series analyzing this question. This post focuses on the competitiveness of the Chinese manufacturing sector. Over most of the past 5 years, China has had an appreciating currency, rising wages, and thousands of factory closings, no doubt due to the wages and the currency issues. Meanwhile, the U.S. government has set a goal of growing manufacturing jobs in the U.S., and the American press has given ample attention to the concept of reshoring, i.e. bringing manufacturing jobs back to the U.S. Given the above, it would be natural for one to think that China's status as factory to the world is a thing of the past. Yet, if you look closely at the situation, it would seem that the death of the China factory has been greatly exaggerated. Let's start by making the following crucial point. Macro-level statistics do not indicate a massive shift in manufacturing. Looking at trade data over the past 5 years, in some sectors like household appliances and consumer electronics, China has actually been gaining market share. In other sectors like toys, shoes, and furniture, China has had slower growth and in some cases negative growth, but not at precipitous rates. In cases in which China has lost share, it is largely Vietnam that has benefited, with Mexico showing limited to no benefit in most sectors. Also, U.S. manufacturing employment and output statistics, while up since the financial crisis, do not suggest a strong influx of products now being manufactured in the U.S. The above facts point to a few conclusions that seem reasonable. First, onshoring is no doubt happening in select areas and by some companies, but there is certainly no tidal wave of manufacturing returning to the U.S., at least not substantive enough to impact imports and manufacturing levels. Secondly, at least from a macro point of view, China is maintaining its competitiveness in higher-end sectors, appliances, electronics, while losing it in lower-end sectors like toys and shoes. This is a sign that China is moving up the value chain, focusing on more value-added products and services, a positive and expected trend in a less developed but rapidly growing country like China. Below are a few factors that help to explain why manufacturing is still relatively strong in China. First, factories are moving inland. As you might know, most of the investment in China over the first 30 years of liberalization occurred in eastern China, which is why the wages are much higher there. So many factories are simply moving inland China to get lower wages. It should also be mentioned that alternatives to China can be hard to find. While other countries can match China's costs, it isn't easy for them to match China's capabilities. Mexico has certainly benefited somewhat from rising costs in China, as we mentioned above, but the statistics don't support the idea that Mexican exports have grown significantly in the wake of rising costs in China. India, which is frequently mentioned as an alternative to China, hasn't seen large gains in exports to the U.S. in any major category that China dominates. Capacity and infrastructure, among other reasons, are an issue for India. It seems clear that Vietnam is making strides in certain areas, but Vietnam has a population of 80 million, roughly 1/16 of China's 1.3 billion, plus Vietnam is a much earlier stage of development. The point is not that there are no alternatives to China. The point is that it took China 30 years to build the manufacturing sector it has, and it will take many years to build an alternative. So the transition of low-cost manufacturing out of China will be a long-term process, not a quick reaction to changes in relative costs. To make my next point, let me cite a few examples. I know a Chinese foundry that a few years ago stopped making low-tech commodity castings and instead only accepted parts that involved a fair amount of machining because the machining meant they could earn a higher margin to counter rising costs. I also know a U.S. specialty electronics firm that has increased its purchasing in China despite rising costs because Taiwanese suppliers of higher-end products in their niche have moved their factories to China. These are two examples of two trends that are happening throughout China. One, Chinese companies are becoming more productive, often by using more efficient equipment instead of just adding workers when they need to increase production. And secondly, Chinese companies are moving up the value curve, as we alluded to above, making more high-end products that require more technical sophistication. Both of these trends help keep Chinese manufacturing more competitive. And one last reason why Chinese manufacturing remains relatively healthy. More and more companies are selling into China. Factories that used to only export out of China are now trying to tap into the Chinese market. So why move a factory out of China if you're actually selling the product in China? Again, one more reason why manufacturing is actually not sliding that precipitously in China. To sum things up, all of the above means that China's status as factory to the world is likely to undergo a gradual transition over time, not a precipitous decline. For companies sourcing in China, while higher costs might suggest that a change is necessary, it is also possible that China still presents the best alternative. That doesn't mean companies should feel beholden to China forever. If there are better options, take those options. It simply means that once all factors are considered, China might be more competitive than you think.